Assalamualaikum. Today I will present about repurchase agreement as known as repo. A repo is a short-term borrowing agreement used by bank and financial institutions for get quick cash. In this presentation, I will explain about how repo works, its benefit, and its risk. Now, let's see how a repurchase agreement works. A repo is a short-term borrowing agreement. Bank A sells security to Bank B and receives cash. Bank A then promises to buy back the same security later at a fixed price. Repo helps institutions to get quick funding at lower borrowing costs because the security acts as collateral. However, there are risks such as a fall in collateral value or a party failing to complete the agreement.
Now, I will explain the key features of a repurchase agreement or repo. A repo is a short-term money market instrument used by banks and financial institutions to obtain temporary funding by selling securities and agreeing to buy them back later. Another important feature is that repos are secured by high-quality collateral such as government securities, which helps reduce the lender's risk. The borrower also agrees to repurchase the securities at a predetermined price, and the difference between the selling and repurchase price represents the repo interest. Because repos are backed by collateral, they have low credit risk. They also offer high liquidity and flexible maturity, making them an efficient tool for managing short-term cash needs.
I will briefly explain the roles of market participants in a repurchase agreement. Commercial banks are the main users of the repo market because they use it to get short-term funds and pension funds and manage their liquidity. Bank Negara Malaysia use repo operation to control liquidity in the financial system and maintain stable interest rate. Institutional investors such as insurance companies and pension funds invest their extra cash through repo because it is a safer investment backed by collateral. Securities dealer help connect buyer and sellers to transaction can be completely smoothly. Lastly, Malaysian government securities or MGS, which are used as collateral in repo transaction and also help finance public spending. Overall, every participant has a different role, but together they ensure the repo market operate efficiently and support financial stability.
Now I will explain how a repurchase agreement or repo works. When a commercial bank needs short-term funding, it sells an MGS to an institutional investor and receives cash in return. The bank also agrees to buy back the same securities at a later date for a slightly higher price. Securities dealer may help by connecting the buyer and the seller and making sure the transaction runs smoothly. During the repo period, the investor keeps the MGS as collateral, while the bank uses the cash to meet its short-term liquidity needs. On the agreed maturity date, the bank repurchases the MGS by paying back the cash together with the repo interest. The investor then returns the securities and the repo transaction is completed. In Malaysia, Bank Negara Malaysia, also known as a BNM, also uses repo and reverse repo operation to manage liquidity in the financial system and help maintain stable interest rate. Overall, a repo is a safe and efficient way for banks to obtain short-term funding while providing security to investors through government securities.
A repurchase agreement offers a lot of benefits to the issuer. First is liquidity application. Through a repurchase agreement, the issuer can immediately receive cash by using their asset as a collateral. This helps them manage their short-term financial needs while still remaining control of the asset. In addition, repurchase agreement offer a flexible payment terms, allowing users to manage their cash flow more efficiently. They also provide swift execution, allowing company to access funds quickly without lagging procedure, while increasing asset by using existing asset to secure additional funding.
Next, I will explain 4 benefits of a repurchase agreement for investor. Firstly, it helps reduce financial risk. Investors temporarily own the security, so if the seller cannot repay, they have better protection and can recover their investment more easily. Secondly, it reduces investment risk since everything is clearly stated in the legal agreement. Investors have more confidence that they will receive the agreed repayment. Third, repurchase agreement provide liquidity flexibility. Investors can invest their money for a short period and reinvest it again, giving them more opportunities to earn returns while helping borrowers get quick funding. Lastly, repurchase agreements are flexible. Both parties can decide the duration, repayment terms, and investment strategy based on what works best for them, as long as both agree and the agreement is legal and beneficial for everyone.